Imagine if you had a path that gave you the power to overcome your biggest weakness in life, a secret that could turn an ordinary person into a successful trader. But most people give up before they even discover this secret. You think trading is just about charts, lines, and numbers? No. The real battle isn't on the charts, it's inside your mind. Today, we're going to talk about a book that has shown thousands of failing traders the way to success. This is Trading for a Living by Dr. Alexander Elder. This book isn't just about trading. It changes the way you think, your psychology, and the principles that protect your money. And the most exciting part? You don't need long lectures or thick courses to understand its wisdom. Right here on Book in Minutes, you'll get the essence of this book in just a few minutes. So stay with us till the end, because this video might just be the turning point that changes your trading journey forever. Is it never common? Imagine standing at the edge of a vast frontier, one that promises freedom, wealth, and excitement, but at the same time hides danger at every step. That is what trading feels like. It's not just another profession, it's the last frontier, where ordinary people can face extraordinary challenges and potentially win big, or lose everything. Dr. 10. Alexander Elder opens this book by reminding us that trading is not a hobby or a quick game. It is a world where intelligence, discipline, and self-control determine who survives and who vanishes. Unlike other professions, no university degree can prepare you for this journey. Here, the market is both your greatest teacher and your toughest competitor. Many people step into the trading arena with dreams of fast money. They look at charts, listen to so-called gurus, and believe they are ready. But the market is merciless. It exposes weaknesses, punishes arrogance, and destroys anyone who is unprepared. Elder compares this frontier to the Wild West, exciting, full of opportunities, but extremely unforgiving. Only those with strong character and clear methods make it through. This opening chapter sets the stage for the rest of the book. It tells us that success in trading is not just about knowing technical analysis or memorizing strategies. It's about facing yourself. Your own fear, greed, and impatience are the real enemies. If you don't learn to control them, no system in the world will save you. Think about it. In most jobs, mistakes cost you time or maybe a paycheck. In trading, one bad decision can wipe out months or even years of effort. That is why Elder insists before you even think about winning, you must prepare to survive. And survival begins with understanding the hidden forces inside your own mind. Because once you learn how psychology shapes every decision you make, you will start to see why so many traders fail and why a few manage to build lasting success. Now, let's move deeper. If the battlefield of trading is not the charts but the human mind, what exactly is happening inside us? Why do people repeatedly make the same mistakes? In the next chapter, we'll explore the key that unlocks the entire game: psychology. Every trader dreams of mastering the market, but very few stop to ask, what is really in control here, the market or my own mind? Elder makes it clear in this chapter. Psychology is not just an element of trading. It is the foundation. Without it, all other skills collapse. Think of it this way. Two traders can look at the exact same chart, read the same news, and even use the same strategy. Yet one will walk away with profit, and the other with a devastating loss. What makes the difference? It's not knowledge, it's mindset. Fear makes one person exit too early. Greed pushes another to stay too long. Impatience blinds them to signals that were obvious in hindsight. Psychology is the hidden hand that guides every click of the mouse, every buy and sell. Dr. Elder emphasizes that the market itself doesn't care about you. It doesn't know your hopes or your fears. but it reacts to the collective emotions of thousands of traders: panic, excitement, desperation. When you place a trade, you're not just competing with numbers on a screen. You're competing against human emotions, including your own. This is why self-awareness is so crucial. A trader must become a student of their own mind. Are you someone who chases the thrill of action, or do you patiently wait for the right setup? Do you get paralyzed when facing a loss, hoping it will reverse? Or do you have the strength to cut it quickly? These inner battles decide whether you'll survive in the market. Elder even warns that most people underestimate this challenge. They think technical indicators will solve everything, but if you can't control your emotions, even the best system will fail you. Your psychology shapes how you interpret signals, how you manage risk, and how consistently you follow your own plan. So the real question is, can you master yourself before trying to master the market? Because if you can't, the market will do it for you, and usually in the most painful way. And this leads us to the next step in Elder's journey. If psychology is the key, then why do so many traders ignore it? Why do they keep believing they can beat the odds with shortcuts and illusions? In the next chapter, we'll uncover the truth about those odds and why the majority are destined to fail before they even begin. Most beginners enter the market with hope in their eyes. They imagine themselves quitting their jobs, making money while sipping coffee, or doubling their accounts in just a few months. But Elder delivers a sobering truth in this chapter. The odds are stacked heavily against you. Statistics show that the majority of traders lose, not because they're not smart enough, but because they underestimate the challenge. Think about casinos. The house always wins in the long run because the odds are designed that way. In trading, the house is not one single institution, but the combination of transaction costs, emotional mistakes, and the natural randomness of markets. Each of these factors quietly chips away at your account, until, sooner or later, most traders give up. Elder explains that professionals succeed not because they know a secret formula, but because they accept these odds and build systems to work with them. They know losses are inevitable, but they keep those losses small. They know gains will come, but only if they have the discipline to wait. Amateurs, on the other hand, often act as if the rules don't apply to them. They risk too much, trade too often, and quickly burn out. Another key point: many traders rely on gurus, tips, or magical indicators, hoping to escape the reality of risk. But every shortcut leads back to the same harsh truth: you cannot beat the market without discipline, preparation, and control. The odds against you are real, and they will crush anyone who pretends otherwise. Yet, there's also a hidden opportunity here. If you accept that most traders lose because of their behavior, then you can decide to act differently. You can prepare where others are careless. You can build discipline where others give in to emotion. That is how you turn the odds in your favor. Not by avoiding risk, but by managing it with intelligence. And this realization naturally raises another question. If so many traders fail, what exactly pushes them to keep going? Why do people return again and again, despite heavy losses? The answer lies in a powerful force: human fantasy. In the next chapter, we'll dive into the dangerous gap between fantasy and reality that traps countless traders in a cycle of hope and disappointment. Why do people trade in the first place? The answer seems obvious: money. But when Elder looks closer, he shows us something far deeper and far more dangerous. Most people trade because of fantasy. This was not plays. They imagine themselves as market wizards, living a life of freedom and wealth. They picture themselves clicking a few buttons and instantly earning what others work weeks to achieve. This fantasy is seductive. It makes people ignore reality, overlook risk, and jump into trades without preparation. In their minds, trading becomes a lottery ticket that will rescue them from their current life. But the truth is very different. In reality, trading is hard work. It demands patience, research, and emotional discipline. It requires the willingness to sit through long periods of waiting and to accept losses without breaking down. Reality is not glamorous. It's the routine of following a system, managing risk, and slowly building consistency. Fantasy is what lures people in. Reality is what keeps most of them out. Elder warns that the fantasy mindset is dangerous because it blinds traders to warning signs. They ignore risk management. They believe losses are temporary and that big wins are right around the corner. They keep adding money to losing positions, convinced their big break is coming. But the market does not reward fantasy. It only rewards discipline and objectivity. This chapter forces us to confront a hard question. Are we trading because we are prepared or because we are chasing an illusion? Facing this truth is painful, but it's also liberating. Once you let go of fantasy, you can finally see trading for what it really is, a serious business that demands respect. And this brings us to another dangerous trap. If fantasy doesn't mislead us, often something else does. The so-called experts and market gurus who claim to have all the answers. In the next chapter, Elder pulls back the curtain on these gurus, exposing why trusting them can be just as destructive as chasing your own illusions. It is no enlight presented with a pressed hour. When traders finally begin to sense that their own fantasies are dangerous, many look outward for guidance. They search for someone wiser, someone who can show them the way. This is where the figure of the market guru enters the picture. But as Elder explains, trusting gurus is often just another trap. Market gurus promise clarity in a world of chaos. They publish books, give seminars, or shout predictions on television. Their words sound confident, even prophetic. To a struggling trader, a guru's certainty feels like a lifeline. If I just follow this person, they think I will finally succeed. But the reality is far less comforting. Elder points out that gurus are human. They make mistakes, they misread signals, and sometimes they're simply lucky. What's worse, many are more interested in selling their advice than in trading themselves. Their business is not the market, it's marketing. By the time their prediction reaches you, the opportunity has often passed. And when they are wrong, they rarely accept responsibility. Instead, they move the goalposts or quietly change the story. The real danger is psychological. When you lean on a guru, you give up your independence. You stop thinking critically, and you hand over responsibility for your own trades. This dependency can feel comforting at first, but in the long run, it leaves you weaker and more vulnerable. Remember, when you lose money following a guru, the guru does not share your loss. You bear it alone. Elder doesn't say that all advice is worthless. Learning from experienced traders can inspire and guide you. But there's a difference between learning principles and blindly following predictions. The only way to survive in the market is to think for yourself, test ideas, and develop your own discipline. A guru can't trade for you. Only you can do that. And this realization leads to an even deeper question. If we can't rely on fantasies or gurus, then what is it inside us that keeps pulling us toward destructive behavior? Why do traders sabotage themselves, even when they know better? In the next chapter, Elder uncovers the roots of self-destructiveness and why mastering it is essential for survival. By now, it's clear that traders can't rely on fantasies or gurus. But what if the greatest danger doesn't come from outside at all? Elder argues that the most destructive force in trading lives inside each of us. Our own tendency towards self-destruction. Think about it. How many times have traders broken their own rules? They know they should cut losses quickly, but they hold on, hoping the market will turn. They know they shouldn't risk too much on one trade, yet they double their position out of desperation. They know patience is essential, but they jump in too early, afraid of missing out. This is not ignorance, it's self-sabotage. Elder explains that self-destructiveness in trading often mirrors patterns from a trader's personal life. People who crave excitement, who gamble, or who struggle with discipline in daily habits tend to carry those same weaknesses into the market. Trading simply magnifies them. A small flaw in character, once multiplied by money and risk, can lead to devastating losses. Why do we do this to ourselves? Sometimes it's unconscious, an inner need to repeat past mistakes, or to seek punishment. For others, it's the illusion of control. They believe they can bend the market to their will, so they ignore warning signs and keep doubling down. But the market always wins against arrogance and denial. The key lesson here is brutally honest. Before you can succeed in trading, you must confront your own destructive tendencies. That means keeping detailed records, recognizing repeated mistakes. The market will not forgive you, so you must learn to forgive yourself, correct the behavior, and move forward with discipline. This chapter shifts the spotlight inward. Elder shows us that the battle is not with the market, but with ourselves. And once you recognize your own destructive patterns, the question becomes, how can you build a healthier, stronger mindset to replace them? To answer that, Elder takes inspiration from an unexpected source, the recovery principles of Alcoholics Anonymous. In the next chapter, we'll see how lessons from AA can transform the way traders approach discipline and self-control. What could traders possibly learn from Alcoholics Anonymous? At first glance, the two worlds seem completely different. But Elder shows us a striking similarity. Just like alcoholics, many traders are trapped in destructive habits they cannot control. And just like AA helps people break free from addiction, its principles can guide traders toward discipline and survival. Think about it. An alcoholic knows drinking is harmful, yet keeps returning to the bottle. A trader knows reckless risk-taking leads to losses, yet keeps breaking the rules. In both cases, the problem isn't knowledge, it's behavior. The battle is not about learning more, but about changing deeply ingrained habits. Elder highlights a few powerful lessons from AA. The first is honesty. Alcoholics must admit they have a problem before they can recover. Traders too must admit when their approach isn't working. Denial only prolongs the pain. The second is accountability. In AA, members share their struggles openly. In trading, keeping a journal serves the same purpose. Writing down every trade winners and losers forces you to face the truth instead of hiding from it. Another lesson is humility. Alcoholics learn to respect their limits and avoid situations that trigger relapse. Traders must do the same, respecting risk, controlling position size, and avoiding overtrading. Success doesn't come from overpowering the market, but from knowing your weaknesses and building defenses around them. Perhaps the most powerful lesson from AA is persistence. Recovery is a lifelong journey, not a one-time fix. Likewise, discipline in trading is never finished. Every day in the market tests your patience, your courage, and your ability to stick to your plan. Progress comes slowly, but it builds strength that lasts. By borrowing these principles, traders can create their own recovery from destructive habits. The market doesn't demand perfection. It demands resilience and self-awareness. And once you begin this path, you start seeing trading not as a quick win, but as a lifelong practice. But there's another side to this struggle. Just as AA has groups to support recovery, Elder describes a world where traders with similar problems gather, except here, they are not recovering, they are losing together. In the next chapter, we'll enter that world. Losers Anonymous. Imagine walking into a room where everyone has the same secret shame. They've all lost money in the markets, sometimes their savings, sometimes their future. Yet instead of hiding, they gather to share their stories. Elder calls this group Losers Anonymous, and in this chapter, he exposes the common mistakes that unite failed traders everywhere. These traders are not stupid. Many are intelligent, educated, even successful in other fields. But when it comes to markets, they fall into the same traps again and again. Some can't resist gambling, placing oversized bets, chasing excitement, and ignoring risk. Others are paralyzed by fear, too scared to act when an opportunity arises, or clinging to losing positions because they cannot admit they were wrong. Different behaviors, same result, financial ruin. Elder makes an important point. These traders often know exactly what they're doing wrong. Just like members of AA who confess, "I knew I shouldn't have had that drink." Failed traders admit, "I knew I shouldn't have taken that trade." Knowledge is not the problem. Execution is. They lack the discipline to act on what they already know. Another theme in this chapter is the power of habits. Losers tend to repeat the same behaviors even after painful losses. Instead of changing, they hope the market will change for them. But the market never bends to wishful thinking. Without a conscious effort to break these patterns, failure becomes a cycle trade. Lose, hope, repeat. The lesson here is not to mock these traders, but to recognize ourselves in them. Every trader has moments of weakness. The difference between winners and losers is not perfection, but the ability to identify destructive habits and replace them with constructive ones. Elder's message is simple. You don't have to stay in Losers Anonymous. You can graduate, but only if you're willing to confront yourself honestly and commit to change. This raises the next question. What separates those who stay trapped in this cycle from those who break free? What qualities turn an ordinary person into a consistent winner? In the next chapter, Elder explores the psychology of winners and losers and the traits that decide who survives in the market. Every trade has two sides, someone who wins and someone who loses. But Elder explains that the difference between winners and losers is not luck, it is psychology, discipline, and consistency. In this chapter, he reveals the traits that separate the two groups. Losers, as we've seen, are driven by emotion. They let fear stop them from acting, or greed push them into reckless bets. They repeat mistakes hoping the outcome will change. Winners, on the other hand, understand that trading is a business. They treat each trade as just one of many, never a life or death event. For them, losses are part of the cost of doing business, not personal failures. One striking difference is how they handle responsibility. Losers often blame the market, the news, or even their broker when things go wrong. Winners look inward. They ask, "What did I do wrong? Did I break my rules? Did I ignore my signals?" This accountability is what allows them to improve, while losers remain stuck in denial. Winners also manage risk with discipline. They never risk more than they can afford to lose. They don't expect every trade to be profitable, but they make sure no single loss can destroy them. Over time, this steady approach builds confidence and capital. Losers, by contrast, swing between extremes, reckless risk-taking followed by fear and paralysis. Elder emphasizes that winners think long-term. They focus on process, not instant results. While losers chase excitement, winners chase consistency. It may not sound glamorous, but over time, consistency is what creates financial freedom. The message is clear. Anyone can move from the loser's camp to the winner's camp, but it requires brutal honesty, self-discipline, and a willingness to change. The difference is not intelligence or education, it's mindset. And now, as we leave the world of individual psychology, Elder widens the lens. Because trading is not only about you, it's about the crowd. In the next chapter, we step into the larger arena of mass psychology to see how the market itself behaves as a living, breathing crowd. Up to this point, Elder has focused on the inner battles of individual traders. But trading doesn't happen in isolation. Every click, every order, every emotion is poured into a vast ocean of collective behavior. And in that ocean, the most basic element is price. Elder reminds us that price is not the true value of an asset. It is simply a snapshot of what buyers and sellers agree upon in a single moment, a reflection of psychology, not reality. When fear dominates, prices collapse far below intrinsic value. And when greed takes over, prices soar far above it, making price a mirror of mass emotion that constantly shifts with every heartbeat of the market crowd. This is why markets often seem irrational. They are not governed by logic alone, but by waves of hope, panic, and excitement. A stock can fall on good news if traders expected even better results, or rise on bad news if the losses weren't as bad as feared. What matters is not the news itself, but how the crowd interprets it. For traders, this is both a challenge and an opportunity. The challenge is that price movements are often unpredictable in the short term, but the opportunity lies in studying crowd behavior through charts, patterns, and indicators to begin reading the emotions driving the market. While you don't need to predict every twist, recognizing when fear or greed has pushed price too far creates setups for profitable trades. Elder emphasizes a crucial point. Price is not truth. It is perception. Treating it as truth leads to frustration, while understanding it as perception allows you to step back, think critically, and avoid being swept away by the crowd. Once you see price as a reflection of mass psychology, the next question arises: what is the market itself? Elder describes the market as a living crowd, an arena where human emotions collide, magnify, and explode into visible patterns on a chart. The market is not a cold, mechanical machine. It is made of people, millions of individuals with different goals, fears, and expectations, from professionals managing billions to beginners trading a few $100s. And together, their combined emotions create powerful waves that shape price, making the market a mirror of collective psychology. Crowds behave differently than individuals. Alone, a person may be rational, cautious, and thoughtful, but in a crowd, emotions intensify. Fear spreads like wildfire. Greed becomes contagious, and logic often disappears, which is why markets can swing violently, rising far above fair value or crashing deep below it, exaggerating reality rather than reflecting it. Success as a trader, then, is not about perfectly predicting news or economic data, but about understanding crowd reactions. Will fear turn a small problem into panic? Or will optimism push prices higher even when fundamentals don't justify it? Reading the crowd becomes as important as reading the numbers. Elder warns against viewing the market as either an enemy or a partner. It is neither. It is an impersonal crowd, sometimes generous, sometimes cruel, but never personal. And this detachment, while harsh, is freeing because it allows you to stop taking losses personally and start focusing on probabilities. Once you grasp the market as a crowd, the next step is to look at the environment it creates. Trading is not just numbers on a screen, but a scene filled with participants, emotions, and signals waiting to be read. Step into a trading room, whether a noisy exchange floor filled with shouting brokers or a quiet home office with one screen, and you'll notice that beneath the technology and numbers, there is always emotion. Elder calls this environment the trading scene, the stage where every player, big or small, acts out their role in the market drama. On this stage, professionals trade other people's money with discipline. Amateurs chase quick profits out of fear of missing out. Institutions with massive resources move prices in seconds, and small traders often get caught in their wake, creating a living marketplace that is both chaotic and strangely predictable. The tools traders use also shape this scene. Screens packed with charts, indicators, and news flashes can overwhelm beginners and tempt impulsive action, while professionals use the same tools calmly and selectively. Like a surgeon and a child holding the same scalpel, skill and mindset make all the difference. Your presence on this stage matters as well. Are you a gambler seeking thrills, or a disciplined participant following a plan? The trading scene magnifies who you are. Bring discipline and it rewards you. Bring recklessness and it exposes you quickly. Awareness is key. You are not trading in a vacuum, but in a crowd, on a stage, where every emotion, mistake, and moment of overconfidence can be punished. Understanding this dynamic lets you position yourself not as a victim of the crowd, but as an observer who learns from it, which leads to the deeper question: how exactly does this crowd behave? If the trading scene is a stage, then crowd psychology is the script. And in the next chapter, Elder explores how mass psychology shapes market behavior, and how understanding it can give traders a powerful edge. Stand in the middle of any marketplace, whether it's a stock exchange, a crypto forum, or even a local auction, and you'll feel it, the energy of the crowd. Elder reminds us that in trading, the crowd is not just around you, it is inside the market itself, and every trader, including you, is a part of it. Crowds behave differently than individuals. Alone, you might be cautious and rational, but in a crowd, emotions intensify. Fear spreads quickly. Greed becomes contagious. A single spark of panic can trigger a wave of selling, and a sudden surge of optimism can push prices far beyond reason. The crowd doesn't think it reacts, and if you're not careful, you'll find yourself swept along with it. This is where self-awareness becomes critical. You cannot control the market crowd, but you can control how you respond to it. Elder stresses that traders must learn to step back and observe the crowd rather than being absorbed by it. Ask yourself, am I buying because I see a real signal, or because everyone else is buying and I don't want to miss out? Am I selling because my system tells me to, or because fear is screaming in my ear? These questions can save you from becoming just another victim of herd behavior. The market crowd also creates patterns. Trends, rallies, and crashes are all products of collective psychology. When you understand how crowds behave, charts stop looking random and begin to tell a story of fear building, of greed peaking, of exhaustion setting in. Reading this story gives you a powerful advantage, because while the crowd is caught in emotion, you can act with clarity. But here's the challenge. You are never fully outside the crowd. Even as you observe it, you are influenced by it, which is why discipline, rules, and self-control are essential. They anchor you when the crowd pulls in every direction. Elder's advice is simple but profound. Respect the crowd, but don't become it. Once you begin to see how the crowd moves, the next step is to understand how those movements create trends, because behind every bull run, every crash, and every sideways drift, there is a psychological engine driving it forward. In the next chapter, Elder explores the psychology of trends and how recognizing them can change the way you trade forever. Every chart tells a story, and at the heart of that story are trends. Elder explains that trends are not just lines moving up or down. They are the living heartbeat of crowd psychology. A trend forms when enough people share the same belief about the future. Prices rise when optimism spreads. fall when fear takes over, and stall when uncertainty dominates. Think about an uptrend. At the beginning, only a few brave traders step in because they see value before the crowd does. As prices start to climb, more people notice, confidence grows, and soon momentum builds. Now the crowd believes the trend is obvious, and finally, at the very top, excitement turns into euphoria everyone wants in. And that's when danger is highest, because by the time the last buyer has entered, the uptrend is already running out of fuel. The same cycle happens in reverse during a downtrend. At first, only a few see the storm coming. Then the decline accelerates, fear spreads, and eventually panic takes over. Just when everyone believes prices will never recover, the market quietly begins to turn again. The psychology of hope, fear, and despair plays out in waves, leaving clear footprints on every chart. Elder's point is that trends are not mystical forces. They are the result of human emotions repeating themselves in predictable cycles. By studying psychology, you can recognize where you are in that cycle. Are traders just beginning to believe in a new move? Is greed pushing prices beyond reason? Is fear reaching its breaking point? These questions help you read the crowd like an open book. But here's the danger. Once inside a trend, it feels natural to follow it blindly. The crowd whispers, "This time is different. This will go on forever." That illusion is what traps traders again and again. But the reality is that no trend lasts forever. Understanding when a trend is healthy and when it's about to collapse is what separates winners from losers. And this is where technical analysis comes in. To measure trends, track their strength, and know when they are shifting, traders use charts and tools. In the next chapter, Elder moves from psychology into practice, introducing the world of technical analysis, the language traders use to make sense of the market's emotional waves. Imagine trying to navigate a stormy sea without a compass. That's what trading without technical analysis feels like. Elder explains that technical analysis is not about predicting the future with magic. It's about reading the footprints left behind by the market crowd. Every price, every bar on a chart is evidence of what traders felt and believed at that moment. And when you learn to read those footprints, the market begins to make sense. At its core, technical analysis is the study of price and volume. Price shows you where the market has been, while volume reveals the intensity of conviction behind each move. Together, they tell a story of supply and demand, greed and fear, strength and weakness. Technical analysis gives structure to this story by turning chaos into patterns. Charts are the trader's main language. Line charts show the big picture. Bar charts reveal highs, lows, and closing prices. And candlesticks add visual emotion, making fear and greed easy to spot. But Elder warns, charts don't speak for themselves. It's the trader's job to interpret them with discipline, not fantasy. A chart is a tool, not a fortune teller. And indicators are another layer of technical analysis, helping confirm what the chart suggests by measuring momentum, volatility, or trend strength. But Elder makes one thing very clear: no indicator is perfect. The real danger is when traders overload their screens with too many signals, chasing certainty that doesn't exist. The goal is to use indicators as helpers, not as masters. Technical analysis, at its best, is about probabilities, not guarantees. It doesn't eliminate risk, but it helps you manage it. By recognizing trends early, spotting reversals, and confirming signals with volume and momentum, you increase your odds of success. Elder's message is simple: trade what you see, not what you hope for. Now that we've laid the foundation of technical analysis, Elder dives deeper into its building blocks. In the next chapter, he explores charts themselves, showing how to read the market's story line by line, bar by bar. A chart is more than just lines and bars. It's the diary of the market. And Elder explains that every tick, candle, and bar is a record of human action, driven by emotions of hope, greed, and fear. So when you look at a chart, you're not just seeing numbers, you're watching psychology unfold in real time. Charts come in many forms, but each serves the same purpose: to make sense of price movement. Line charts give a clean, simple view of closing prices. Bar charts reveal highs, lows, and closes within each period. And candlestick charts go further, painting emotions onto the screen, where a long green candle shouts confidence, and a long red candle whispers fear. And patterns emerge because human behavior repeats, with charts capturing that repetition. Elder reminds us that charts are tools, not crystal balls. They don't predict the future. They show where the market has been and hint at where it might go next. A chart can't tell you buy or sell, but it can show whether the crowd is becoming stronger, weaker, or exhausted, helping you separate noise from meaningful movement. Traders often fall into the trap of seeing what they want to see in charts, bending patterns to match their hopes, and Elder warns against this illusion, emphasizing that the key is discipline, letting the chart speak for itself, even if it says something you don't like, because success comes from objectivity, not imagination. Charts become even more powerful when combined with other tools. Volume confirms whether a move is genuine, indicators measure strength, and timeframes show perspective. Since what looks bullish on a short chart may look weak on a longer one, so a skilled trader doesn't rely on a single chart, but builds a story across multiple views. Once you read charts with clarity, you realize they are not just pictures, they are windows into crowd behavior. And from here, Elder leads us to indicators, the mathematical companions that help traders measure what the eye alone might miss. Indicators are like accents in the language of the market, highlighting what is already there and making patterns easier to see. They act as filters, smoothing out the chaos of raw price charts to show underlying strength or weakness, momentum, trends, volatility, or even crowd sentiment, giving traders a sharper edge when used wisely. But the trap for beginners is treating indicators like magic signals, piling 5, 6, or even 10 on a chart and waiting for all to agree, which Elder warns leads to confusion. Because indicators are meant to support analysis, not replace judgment, and too many signals create paralysis and missed opportunities. Momentum indicators like RSI or stochastic oscillator show overbought or oversold conditions. Trend indicators like moving averages confirm direction, and volume measures conviction, with each having its role. Though none are flawless, the secret lies in combining them wisely, keeping your screen clean and mind clear. Elder emphasizes divergence when price and indicator disagree, like prices climbing while momentum fades, which often signals a trend running out of steam, creating golden opportunities for traders who listen. At the end of the day, indicators are like instruments in an orchestra. Alone, each makes a sound, but together, used with discipline, they create harmony. Though too many instruments playing at once create noise, so the message is simple. Choose indicators carefully, understand their purpose, and let them confirm, not dictate your trades. From here, Elder dives deeper into technical analysis by exploring patterns, the repeating shapes on charts that reveal how psychology turns into price movement. Patterns are the fingerprints of the market crowd, and Elder explains that when enough traders act on similar emotions, fear, greed, hope, their behavior leaves behind repeating shapes on charts, which are not magic but visual evidence of psychology in action. Some patterns are simple and easy to spot. A breakout from a tight range often shows the crowd has made up its mind after hesitation. A double top signals that buyers tried twice but failed to push prices higher. And a head and shoulders formation tells the story of a trend running out of steam. Each shape is more than a picture. It's a story of buyers and sellers battling for control. The key is not to memorize every pattern, but to understand the psychology behind them. When prices rise into resistance and pull back, it reflects hesitation and profit-taking. And when prices test the same level multiple times, it shows a tug-of-war between bulls and bears, because patterns emerge from repeated human behavior and emotions rarely change. Elder warns against seeing patterns where none exist, as many traders force shapes onto charts, convincing themselves they've found a perfect setup, which is dangerous because patterns only matter if confirmed by volume, momentum, and trend context. A head and shoulders in a quiet market means little, but in an active trend, it can be powerful. Patterns work best when combined with discipline. They don't predict the future but suggest probabilities, and a breakout could succeed or turn into a false signal, which is why Elder stresses risk management. Never bet your entire trade on a single pattern. Use stops, manage size, and treat every signal as part of a larger puzzle. When traders master patterns, they see the market differently. It's no longer chaos, but behavior, psychology, and repetition turned into pictures. And from here, Elder moves to the final building block of technical analysis: moving averages. The simple yet powerful lines that help traders ride trends with clarity and confidence. Among all technical tools, moving averages are perhaps the simplest and most powerful. Just the average price over a selected period, plotted as a line that moves forward with each new bar. But despite their simplicity, these lines help traders cut through noise and see the market's true direction. Short-term moving averages hug price closely, reflecting immediate action and short-lived trends, while long-term averages move slowly, showing broader direction and filtering distractions. Together, they create a map where short-term averages reveal quick swings and long-term averages show the underlying tide. And watching their crossovers highlights moments when momentum shifts. The magic of moving averages is their ability to smooth chaos. Price bars can be noisy and volatile, and a single average lets you see if the crowd is pushing upward, downward, or drifting sideways. It doesn't predict the future, but helps you avoid fighting the trend. Elder warns against overusing them, as piling 5 or 6 averages creates clutter. Simpler is better, and a clean chart with 1 or 2 key averages often works best. Moving averages also serve as dynamic support and resistance. A rising average can hold price up, while falling below a key average signals weakness, reflecting crowd behavior as traders worldwide watch these lines, giving them power. Ultimately, moving averages are guides, not magic. They keep you aligned with trends, helping you ride waves rather than fight them, and combined with patterns, indicators, and risk management, they become one of the most reliable allies in a trader's toolkit. From here, Elder prepares for the next stage, where technical tools meet something just as critical: understanding yourself as a trader. Because psychology will always be more powerful than any line on a chart. Up to this point, we've explored tools, charts, indicators, patterns, moving averages. But Elder reminds us that the greatest challenge isn't the market, it's you. Psychology, risk management, and discipline are what separate survivors from those who blow up their accounts. Trading stirs the strongest human emotions: fear, greed, hope, and regret. And these emotions show up in every chart pattern and price spike, with fear making traders sell too soon, greed making them hold too long, and hope blinding them to reality. So to succeed, you must recognize these emotions in yourself and act with discipline rather than impulse. Risk management is the trader's armor. No trade is certain, no matter how good it looks. So every position must have a predefined stop, an exit point to admit you're wrong, and protect your capital. Because professional traders know survival comes first. If you protect your money, opportunities will return. But losing too much in one trade ends the game. Rules are the glue holding psychology and risk together. A trader without rules is like a ship without a compass, drifting and vulnerable. whereas rules define how much to risk, when to enter and exit, and how to respond to losses, protecting you from emotions in the heat of the moment. Elder's approach balances human emotion with structure, showing how to keep feelings from running wild so trading becomes a professional business, not a gamble. And while charts and indicators guide decisions, psychology, risk, and rules decide your fate. The traders who master themselves survive, while those who ignore these lessons eventually burn out. To go beyond theory, Elder emphasizes building a complete trading system, combining tools, discipline, and self-awareness into a working plan. Such a system is not magic, but a set of rules guiding every decision: when to enter, exit, is worrying out, how much to risk, and when to step aside, because without it, even the best trader is vulnerable to impulses and emotional mistakes. A good system has 3 pillars: method, money management, and mindset, where the method is the strategy itself. Money management defines how much capital is risked and how to protect it, and mindset ensures rules are followed with discipline rather than emotion. Systems don't need complexity. Simplicity often works best, such as a moving average crossover, combined with volume confirmation and a fixed stop loss, with consistency more important than intricate details. Testing is critical. Every system should be tested on historical data, in paper trading, and only then with real money to filter weak setups and build confidence. The value of a system lies not in predicting the market perfectly, but in giving a framework to operate within uncertainty, helping you survive losses, capture profits, and stay consistent, making the system your trading compass that prevents aimless wandering. And in the final stage, Elder guides us beyond basics into advanced strategies and practical advice to integrate everything into a trader's lifelong journey. As we reach the final stretch of Elder's work, he shifts the focus from theory to practice, because knowing how to trade and actually trading are 2 very different things. And advanced concepts are not about complexity for its own sake, but about sharpening your edge and preparing for the realities of the market. One of Elder's key lessons is flexibility, as many traders fail by clinging to a single tool or strategy even when conditions change, whereas the advanced trader adapts, switching gears when volatility rises, tightening stops when uncertainty increases, and stepping aside completely when the market becomes too noisy, because adaptability is a form of survival. Elder also dives into multiple time frames, showing that while beginners often look at only one chart, professionals zoom out and in, analyzing the big picture on weekly charts while timing precise entries on daily charts, preventing themselves from being trapped in noise. Record keeping is another essential. Every trade should be logged: entry, exit, size, reasoning, and outcome, not just as statistics, but as a personal textbook to reveal patterns in your own behavior, helping eliminate repeated mistakes and refine what truly works. On the practical side, Elder warns against chasing perfection. No trader or system guarantees certainty, so the goal is not to win every trade, but to manage risk and tilt probabilities in your favor, transforming trading from a gamble into a professional practice. Ultimately, Elder closes with a powerful reminder that trading is not a sprint, but a lifelong journey, where tools, indicators, systems, and advanced tricks matter, but discipline, persistence, patience, humility, and respect for risk matter more. And the traders who survive and grow are those who treat this craft with seriousness, integrating every lesson into a complete blueprint for mastering both the markets and themselves. Looking back over the journey through trading for a living, from psychology to technical tools, risk management to system building, Elder's message has been clear. Success in markets is not about shortcuts or secrets. It's about discipline, structure, and self-mastery. Because so many traders lose money not from lack of knowledge, but lack of control over their own emotions. And the markets reflect our strengths, weaknesses, and deepest fears. So winning requires not just strategy, but self-awareness. We've learned how to silence the noise of gurus and hype, filter trades with indicators, manage risk professionally, and tie everything together into a system that works. And as Elder reminds us, trading is a lifelong craft, a journey of constant growth. So the key takeaway is simple. Don't trade for fantasy. Trade for reality. Respect the markets, your capital, and most importantly, yourself. The market will always test you, but with discipline and patience, trading can become not just a profession, but a way of living. This has been Trading for a Living by Dr. Profession, Alexander Elder, brought to you by Book in Minutes. And if you've enjoyed this deep dive, share your thoughts in the comments about what lesson hit hardest and which you'll apply first, because knowledge only matters when put into action. And with that, our journey with Elder's masterpiece comes to a close. But remember, the end of one book is just the beginning of another. So stay curious, stay disciplined, and keep growing. Until next time, this is Book in Minutes, bringing you the wisdom of the world's greatest books, one chapter at a time.